Thanks so much for tuning into this Editor's Take, wherein me, Neeraj, Vishwanath Nair and Agam Vakil will give you a snapshot of what stood out for us as we've covered 2 days of the India Investor Summit at JPMorgan. And guys, for me, frankly, the overarching theme was that India stands out from investors and the JPMorgan team alike, and corporates, by the way. We met a couple of corporates off the meetings as well. But that India is not decoupled, and if the world sees stress, which may happen over the course of the next 12 months, then India will likely follow the world's suit in terms of getting impacted in a meaningful way over the course of the next 12 months. For you guys?
Well, as far as I'm concerned, I think the point about India's bond inclusion was something that a couple of speakers did tell us, and that was something that is keenly watched out for in terms of the inflows that will follow. Also, the point that the current macro scenario, as well as the monetary policy part of the economy, both of those are looking fairly strong in terms of their ability to achieve the results that they were intended to. So those pointers I thought were big takeaways, because if large investors are looking at it from that point of view, then India becomes a better investment scenario for sure. Agam.
Right. So I spoke to two heads of research from two very different sectors. Information technology on one end and consumption on the other end. We know that both the sectors have been under a little bit of stress. They've had a tough year going in, but we're starting to see a little bit of positive factors coming in through both the sectors. But really, it's going to be a little bit more about consolidation over the next few quarters before we actually start seeing a meaningful improvement in both the sectors, in fact. Let's not forget that at least when it comes to consumption, it's also an election year. So that could also be one of the other factors that could play in favor of consumption improving going forward.
So actually, let's make our viewers hear some of the key takeaways, right? And let's start off with where Agam left off, and which is maybe stress over the next few days, weeks, months. And Sanjay Mukim, who's the India equity strategist, spoke at length about how equity markets could be under a cloud. He effectively said that he doesn't see any meaningful upsides for the Indian equities as well as the world equities, and that is something that investors should certainly take note of. Here out a slice of that conversation.
So we were tactically bullish in March, and we turned cautious end July.
Right.
And the reason for that, Neeraj, was not valuations, it was actually liquidity. Okay. And we've seen for the last 15 years that global equity markets react to injections and withdrawals of liquidity by the major central banks. Yeah. In March, the Fed injected liquidity for the bailout of the small banks. We saw the market start to rally, growth started to rally, mid-caps in India started to do well. Starting July, June, you started to see the liquidity withdrawal happen as well. And this is for a shorter term trade. Our research has been very clear. Valuations are your second filter. The first filter is earnings momentum, which is then amplified and multiples by the liquidity phenomena. So will I be positive now? The answer is no, because we continue to see liquidity withdrawal by central banks happening for the next several months, right, which should put a lid on equity upside here on.
Your assessment of what market returns are likely to be because of the overarching factor of liquidity, where is it that you still find comfort to be able to tell your investors at the conference that these are the pockets that you as a team strongly believe still have a chance of outperformance in an otherwise sideways to a faltering market?
Okay. So there are 2 or 3 answers to that question, Neeraj. Okay. If you have a longer horizon, so let's say you're invested in India and you have the patience to be in here for the next 3 to 5 years, then you still may find enough companies which are executing well, which have growth visibility remaining very strong, and therefore you may then be willing to say that, okay, maybe the multiple's a bit too high, but I'm here for compounding and this is good for me. But the problem is, Neeraj, that most of my investors think of the structural story and the demographics, but expect returns in 12 months, right? And that's the challenge. So if you're looking for shorter term return, then you have to necessarily worry about the market direction, which we think is negative, and we think markets will be flat to down for the next several months. In which case, very few will go up. Within the large caps, the only space that continues to make sense, and this has confounded all strategists everywhere in India, is the banks. Okay, because the banks have delivered earnings, they delivered earnings upgrades, and are properly valued. Right? It's like, all strategists in the world saying equities will go down. Every major strategist in the world thinks equities has a downside, but the market holds up. Same in India, every strategist, every buy-side investor will tell you the banks looks great. The banks have struggled to perform. But if you were to screen the stocks credibly, that's the one space that makes sense on a valuation versus growth trade-off. So that's our core portfolio. It's been for 2.5 years now, and we continue to recommend that.
Yeah, so that was Sanjay Mukim. What we also did is have a conversation with Jahangir Aziz, the head of emerging market economies at JPMorgan. And the point that he was trying to make during this conversation is that this inclusion of the Indian bonds within the emerging market index at JPMorgan itself, that is obviously going to bring in flows. But what it also does essentially is bring in this foreign capital into the domestic market, increases the depth of the market, and thereby ensures that there is more reflection of the macroeconomic realities in the market. His point was that currently the bond market is reflecting what is happening on the regulatory front, which doesn't give through enough feedback for the investors. So this will definitely help. And obviously it's not going to happen immediately. It's going to happen over a 2 to 4 year period of time. But that was definitely a point that I thought was a big highlight from that conversation. Let our viewers watch that.
This is probably one of the big critical moves that India was supposed to make. We had been talking about it for many, many years. And finally, India's made that move. And I think that we need to look at the move from what it does to the efficiency of the market. So most of Indian bonds used to be held very captive by domestic holders, whether they are LIC or other pension funds or banks. So their things that shocks that hit them were basically the same all the time, right? By allowing foreigners to hold, and particularly passive investors to hold it, you are now creating another group of people with different kinds of liquidity shocks that will hit them, right? As a result, you're diversifying your source of funding. And that diversification of the source of funding is a very important step in terms of price discovery of what is the true value, let's say, of the 10-year rate, and not what is being driven by regulatory restrictions that are imposed on LIC and on banks, right? Yeah. As we know, there are a significant amount of those things over there. So it will finally, hopefully, over a period of time, by a period of time, I mean 2, 3, 4 years' time, Indian bonds will start reflecting the macroeconomic realities rather than the regulations under which they are operating. So that's the big step. And the other step that it does is that because it was always held so captive, right? And the ones who are holding those bonds were under serious capital controls. So they could not, go somewhere else. Finally, you'll have a set of investors who can actually move out of Indian bonds if, for example, fiscal discipline isn't maintained. So for the first time, I think you're not only going to get price discovery, but you're also going to get market discipline on the government, which we never had.
So we also spoke to Sajid Chinoy, and he had some very interesting points with respect to the fiscal deficit and consolidation going in and how it could be critical, especially when we talk about FY24. Neeraj, anything that stands out here?
Yeah, and just that point that he mentions that while we are grappling with a lot of other crises of sorts until the next elections, post that, to his mind, sticking to the path and maybe even beating that path of fiscal consolidation that government has laid out would be very, very critical from the macroeconomic stability. In fact, the best to do justice to this answer is actually hear him out on what he has to say when it comes to this particular thing.
So I think there's no doubt that there's been a massive transformation on the macro stability front over the last 10 years. And to policymakers' credit, it started right after the last taper tantrum. I think there were two immediate realizations. One is that you can't have a situation where inflation is in double digits like it was in 2011, 2012. And so we've had an institutionalized flexible inflation target. I think people don't appreciate how well it's performed. Between 2016 and 2020 January, headline CPI averaged 4%. We actually met our target. Now, between 20 and 23, it's averaged 6% for reasons we all know, but at least we're in that band. And the MPC, through its action, seems determined to bring inflation back in the band. So you're seeing a massive downshift in inflation. Along with that has come higher real rates. Real rates were deeply negative 2010, 11, 12. Real rates have been consistently positive since then. They were negative in the pandemic. We're back again in positive territory, right? I think the second lesson was buffers matter. That foreign exchange currency buffers matter hugely and perceptions of buffers matter, right? India had sufficient buffers in 2013 by conventional standards. We had reserves were $280 billion and, it was worth almost 6 months of imports, and that's more than sufficient. But the perception was that India didn't have enough. And then that creates a catch-22, because if the central bank intervenes and uses buffers and you run it down, then you're accentuating the perception that there is inadequate buffers. If you don't use buffers and the exchange rate overshoots, then that begets more weakness. So I think what the central bank has correctly done, in my view, in the last 10 years is that every opportunity buy dollars. Right? At the start of 22, we had almost 700 billion. And there was no shadow of a doubt that the central bank had more than enough ammunition. It could intervene expansively. It did almost $90 billion in the middle of last year and still have enough. So I think the second lesson is buffers matter. The third is that external metrics matter. We've always been a country with low external debt. But there was a perception somehow in 2009, 10, 11, 12 that the exchange rate was strengthening, was misaligned, was overvalued. The last 4 or 5 years, Neeraj, if you look at the broad trade-weighted real effective exchange rate, it's basically flat. Now, I personally, as an economist, would like a slightly weaker exchange rate to boost competitiveness in a world in which exports will be challenged. But at least there is no market perception that this exchange rate is misaligned. So I think there's been a very conscious effort to ensure that the fundamentals, exchange rates, foreign exchange reserves, real interest rates, inflation, has gapped down and is within sustainable levels. And therefore, there's been such a strong evolution. I'll end by saying, you said, is there unfinished business? There always is. In our case, it'll have to be on the fiscal. We have, to policymakers' credit, there is a fiscal consolidation roadmap, but it's important, I think, to be on that roadmap and, if possible, from next year, beat that roadmap. Because when you think of the current account is nothing but the investment saving gap of the economy, which is the consolidated fiscal deficit and the private sector's investment saving gap. Now, if you do get a private capex cycle, as we are all hoping, in the coming years, then by definition, the private sector's investment saving balance will worsen to finance that capex cycle. And that's precisely, you want the government deficits to come down so that this does not spill over into a current account deficit.
Well, you heard Sajid Chinoy, and we'll hear a bit more of him later on. But I think it's important to bring in a bit of perspective of India versus the rest of the world. And Filippo Gori, CEO Asia Pacific, spoke about this beautifully when asked about what's happening in the Southeast Asian and the South Asian economies, and is India really standing out? So, like we said at the start, that India is a bit of a standout feature, but India is not alone. There is traction in Japan, there is traction in South Korea, there is traction in India on the M&A front, and for JPMorgan as well. From amongst a lot of other economies, India is standing out, yes, but it's not the only game in town. However, there's a lot of stuff happening in India which excites JPMorgan to have a strong 55,000 workforce in India, especially on the service export side. 55,000, that's large, yes. Yeah. So he spoke about the growing importance of India within the JPMorgan sphere, as well as for the world at large. Hear out Filippo Gori.
There is excitement around the opportunity set that the region is providing us, because if you think about it, by the end of this decade, Asia will probably represent 50% of the GDP of the world, will be housed in this part of the world. Therefore, there is an element of excitement in our minds to think about, if we want to remain the largest financial institution in the world, or one of the largest financial institutions in the world, we have to have a large presence in Asia Pacific. And we have a large presence in Asia Pacific. If you think about India, for instance, it's the country in the world after the US where we have the largest physical presence. We have over 50,000 employees. We just inaugurated with Jamie Dimon the new Mumbai campus. There's another one just opened in Bangalore, state-of-the-art campuses for our employees. The talent pool that we have found in India and more broadly in the region has been amazing. Now, there are growth differentials, there are different opportunities depending on how you look at the region, but our ambition spans the whole Asia Pacific, starting from Japan at the north, Australia to the south. Southeast Asia is providing us with interesting opportunities, and of course, India, which there is an excitement and a buzz in the room here at the conference, if you think about it, because India this year will probably be the fastest growing economy among the largest economies in the world. So there is this excitement. No? Over 80 corporates represent over 600 investors. It's interesting to be part of this moment.
That was Felipe Gori. Neeraj, the one other point that Sajid made during the conversation was regarding the current account deficit as far as India is concerned. The point that he made was that neutrality on the CAD front, which seems that India is hurtling towards, that may not be such a great thing, right? If you want to...
Yeah, so Neelkant spoke about it a few days back, Vishy, and I would love to understand your perspective here. If Agam has one, then that too. But, it's interesting that everybody's talking about how CAD neutrality is great from a bond market perspective, from a currency perspective, but both of them, and Sajid in particular, mentions that he hopes that we don't become CAD positive or CAD neutral, but remain CAD deficit, because we are an emerging growth country and we need to finance the growth with borrowings. And if we actually become CAD neutral, then we may not be doing justice to our growth potential. It's something that I think we've heard in the past from Neelkant as well.
Yeah, so the point that the most emerging market economics experts or people who focus on India a lot say is that for a country like India, which is capital starved, there is a need for that inflow of capital, and you can't have a CAD neutral economy and then ensure that money keeps coming back in. Let Sajid explain that better. Why don't you watch that?
JPMorgan has 55,000 people in India, right? Most of our global research, technology, cybersecurity, legal, accounting is done from India, and many multinational companies are following suit. Now, I'm going to take the opposite stand that it is not desirable for India to have a zero current account deficit or a current account surplus, because given our level of per capita income, as I mentioned, the current account is simply the investment savings gap. We want more investment. We want more investment than our domestic savings can finance, and therefore it's desirable to run a sustainable current account deficit, 2% of GDP. Operationally, what you will see, hopefully, is that even as savings have picked up, service exports have picked up, when we do get that private capex cycle we've all been waiting for, right, and domestic demand strengthens and broadens, that will show up in higher imports. Right now, most of our imports are consumer goods imports. What we want are capital goods imports to reflect the fact that a capex cycle has started. So it's not a good thing to run a current account surplus, because that may be an indication of depressed demand. You want to run a current account deficit at our level of income to attract stable capital from the world. FDI, for example, right? So think of the current account deficit as being foreign savings that are augmenting domestic savings to finance investment, which is what we want.
Right. But it could well happen that the nature of this whole equation may change, in that there are higher exports, services plus maybe goods, hopefully, and there are reduced imports, even though it's just a trickle right now. But we're seeing electronic imports getting attacked meaningfully. So could it happen that what will be the nature of the current account deficit 2 years out or 3 years out?
Could be different. Yeah, I'd be a little bit more careful about extrapolating on exports, because unlike the 2003 to 2008 cycle, we're seeing a world that's becoming more and more protectionist, more and more deglobalized, more and more economically balkanized. So at least on the goods front, we'll have to work really hard to boost our goods exports. This is not like a rising tide lifts all boats. We'll have to work hard to increase our share. Service exports have done very well, but for the last few months, if you'll notice, they've kind of tapered off in level terms. So it's a high level, but we're at that kind of $27, $28 billion gross service exports a month for the last 5 or 6 months. So this is really good, but we shouldn't presume that exports are going to be strong till the eye can see. We have to work to make that happen.
Right, so that was Sajid Chinoy. Now let's shift focus to equities, and particularly the IT sector, which we know that has been under a lot of stress. In fact, we saw a lot of downgrades and guidances coming on earlier in the year, and yet we've seen a lot of these share prices come back to where they were at the beginning of this financial year. So Ankur Rudra is of the view that while there has been a lot of pressure, what he's going to keep an eye out on is discretionary spending. Remember that JPMorgan is underweight on all the IT companies at the moment. So I asked him, what are the factors that will lead him to perhaps re-rate, and it'll be essentially discretionary spending, which we have not seen in the year so far. Moving on, perhaps a little more interesting conversation that I had with him was around telecommunications, because once again, he's underweight both Vodafone Idea as well as Bharti Airtel. And this is where he mentions that we have seen a lot of investments in 5G, and we are also seeing tariff hikes not coming through. So here, this is where he mentions that capital expenditure, when that starts to go down, is when he expects re-rating to happen as far as telecommunication stocks are concerned. This is what he's saying. Listen in.
Interesting thing in India has been we've seen one of the most aggressive 5G rollouts in the world. Probably faster than the US. We just spoke to Akhil, from Bharti, just a few hours ago, and I think Akhil Gupta was highlighting from Bharti that we've probably had the fastest except China, right? So we are at about 330,000 5G base stations over the course of this year, and that's more rapid than what's happened in the US. The problem is that monetization is not happening. Right, nowhere in the world have telcos been able to really monetize the 5G capex investments, and any kind of delay in tariff recovery or price repair, basically has a negative impact on ROICs for the industry. So that's what makes us, a bit more, worried about the industry, which is what keeps us, on the underweight side of things. So we are waiting for, the capex intensity to recede. Once we see capex going away, and our analysis for Asia Pacific telcos also have suggested that markets which are on the which have gone beyond the 5G peak, that's where we start seeing capex undershooting, which is a great time to own telcos. So I think that's maybe one thing. Second is if there's any kind of improvement on the ARPU side, that will make us potentially more positive. If there's any kind of new sources of revenue monetization, fixed wireless, maybe we've seen a huge amount of fixed wireless launches in the last one month, both from both the main operators. And if that is successful, if it genuinely creates a new opportunity, those things are what we'll really watch for. Eventually it's ROICs. If you see any kind of improvement, chances of improvement on ROIC, that probably will make us more constructive.
Right, so that's Ankur Rudra and his view on telecommunications. We also spoke to Latika Chopra on the consumption theme. And what's really come through is that it seems that from her point of view, the decline in overall consumption volume seems to have arrested for now.
Staples.
As in staples specifically, we are likely to see a little bit of an improvement, not a massive one, but a little bit of improvement with the help of a low base as well over the next few quarters. And she also makes a mention of the fact that we are going to festive season, and there could also potentially be some amount of government spending when it comes to elections, which could likely lead to slightly better numbers. But she explains this here to us in terms of what we can expect going forward as far as the staple sector is concerned. Listen in.
Clearly uneven monsoon this time, has emerged as a risk. After a rainy July and a dry August, September rains have revived, and the monsoon deficit as we speak stands at about 6% versus, where we started at about 11% at the beginning of the month. I would say, if you look at the company narratives, if you look at, the Nielsen data, where you have started to see rural uptick happening, moderating inflation is definitely helping the cause. Right. What is the impact of this kind of monsoon? And we are still to end the month, but, we can only know for certain with a lag. But if you look at the historical data, it's interesting that there is no material correlation between FMCG volume growth rates and the monsoon data also. So, there are other factors at play as well. But when you look at the urban discretionary demand, that's got a mixed, behavior. And much of the segments like, QSR, durables, fashion, all these categories have seen an impact, on urban demand due to the inflationary pressures. Right. We are kind of lapping one full year of that now. And starting December quarter, we have to watch out if there are any green shoots there. Right. We also have a festive season, which is later this year, mid-October to mid-November. And, we are hopeful, it really is good so that it supports the urban discretionary demand to come up.
Okay, so that's Latika on staples. Must say the view around consumption at the higher end is materially different. And a bunch of investors that we spoke to are talking about how the K-shaped recovery or the K-shaped consumption split is widely visible. And at the broader end of the spectrum, and there's Indian hotels out here in this conference also apparently talking about the benefits from the World Cup as well as G20, so on and so forth. So that split apparently there. But needless to say, lots of opportunities and challenges as we wrap up this editor's take. around what has come up from such an informative conference. So lots of challenges. No one spoke about elections, by the way, thus far. They're about 8 months away, but that didn't appear in the realms of conversation. But fiscal, a slowing global economy, all of those are clear and present challenges. In addition to that, the unseen troika leading to inflation, which is higher oil prices, higher other commodity prices as well, and slowing growth, but US exceptionalism, wherein US is actually seeing quite of that uptick because of the rollouts that have happened. So I think that seems to be the crux of the matter when it comes to investors as well as the sell side advising them. So to our mind, viewers, this is the key takeaway of the JPMorgan India Investor Summit, and hope this was informative for you. From Agam, Vishwanath and me, Neeraj, thank you so much for tuning in.